Have you ever wondered how some investors can buy between 10 to 20 properties while on the average income, while other investors can only buy 2 or 3 properties and then they're fully capped out by the banks? Well, today in this presentation, I'm going to reveal the complete secrets of how these people are able to implement this strategy and how you can implement this same strategy for yourself to buy potentially unlimited properties while still being on just an average income. But why should you listen to some guy on the internet? Well, my name is Wilson Yuan. I'm a mortgage broker for the last 10 years, and I've implemented this same strategy for hundreds of my clients and also for myself to help us grow our property portfolios. So if you're interested in using this same strategy, feel free to click on that link below and book a call with me. So let's get straight into it. Hey guys, in this presentation, I'm going to reveal the borrowing capacity hack that can allow you to buy potentially unlimited properties while on just an average income. Now, before I sort of go into the strategy and reveal, how it all works and how you can implement it, I need to first mention what is the biggest problem, right? For most investors. And I've interviewed so many investors, I've talked to so many investors as a mortgage broker, and the biggest problem that I hear from them is that they can't borrow after a certain point. So maybe after the third or fourth property, the bank's told them, no, you can't borrow anymore, even though on paper and on their figures, they got enough income, they got the cash flow to sustain it. The banks just simply won't give them any more money. So I wish for these investors that before they reach that point, and for all these people that are watching, I wish I could show you potentially the strategy that you could implement to help you avoid that problem and help you buy 10 to 20 properties and potentially unlimited properties without being capped. So this presentation is going to reveal. So the topics that I'm going to cover is firstly, why does this happen? Why do most investors hit borrowing capacity war? So you can sort of understand the context. The second one is sort of how to avoid being capped. The third one is how people can buy 10 to 20 investment properties on an average income. The third or fourth point is what is a trust and how it works. My final point is I'm going to reveal is the trust and how this trust lending can allow you to buy multiple properties. And I'll go into much more detail into how the nuance and how it all works out. So let's look at the real numbers. Less than 1% of investors in Australia have more than 5 properties. So majority of investors have between 1 to 2 properties. And the reason is the majority of investors are sort of capped out, right? And what that means, even though they want to borrow more, they have the money to borrow more, they can't borrow more from the banks. The banks told them no. Now, the question I bet all you guys are thinking is, why do most investors hit a borrowing war? And it's a good question, because if you're an investor, let's say you bought one positive geared property, you bought another one positive geared, in theory, in your mind, because they're positive geared and you're making money from each deal, you should be able to buy unlimited properties, right? And the reality is that the way this is interpreted by banks is completely different. So how you view it is completely different by the banks. And what I mean is each time you buy an investment property, even if it's a positive geared, majority of the time your borrowing capacity is reduced. And the reason is because of these 2 key lending policies. So first was the buffer rate. So banks add a buffer of around 3% on your actual interest rate. So if your actual interest rate is 6%, you add 3% on top, that means your rate is 9%. And what that equates to in terms of repayments is that's almost like a 1.5 times multiple of your repayments, right? The second thing that they do is they shade your rental income. So let's say you're earning $4,000. Well, the banks will shade between 10 to 20% of that rental income to cover for property maintenance, fees, agent fees, all the costs involved with running your property. They shade those incomes. So I'll give you a best example, right? Let's say you got a property of 600,000. Let's say you got a rent of 4,000. And your mortgage payments is around 3,600. So you're about $400 positive cash flow, right? Now, what happens is, even though you're $400 positive cash flow, in reality, the way the banks view it is they implement these bank policies. So what they do is the first one, their rental income, they shade it by 20%. So instead of your rental being $4,000, they shade it to $3,200, and they add a 3% buffer on your rate. So your interest rate is now 9%, which means that your monthly payments have jumped to almost $5,000. So in this example, this is a $400 positive cash flow property. The banks, instead, in the bank size, you are a negative cash flow. You're losing $1,600 per month, right? So that means that even though you buy positive cash flow, in the bank size, it's negative cash flow. So imagine what happens if you buy a neutral property or you buy a negative geared property. It's going to be even worse. It's going to be a neutral property is going to be even more negative geared, and a negative geared property is going to be even more negative geared under the bank sides. So here's a real world example. We've got a couple earning 200,000 a year. They want to buy a couple properties under 750,000 with a $650 week rent. So I want to show you how it happens when you buy on the personal name and what happens in terms of your borrowing capacity. So you can see here, this is the borrowing capacity when they buy the first property under 750,000 with a 650 rent. Now I'm going to show you what happens when they buy your second property. So let's say you buy another property. So when you buy your second property, your borrowing capacity is good. So now you've got, let's say your total loan's 1.5. You still have, you can borrow up to 2 million. So you still have 500K left. What happens is when you buy your third property for 750, this is when you sort of get in trouble because now you are close to you're pretty much fully capped. So you can see here, you're fully capped in terms of your borrowing capacity is all red. So you can't borrow anymore in this instance. So, or you can, but you're stuck with like these third tier lenders like Liberty Latrobe, Resimac, and Liberty Latrobe, where the rates are higher. But pretty much at this instance, 99% of the banks, you're fully capped out at this point. And this is only 3 properties which you bought under your personal name. So that's what happens where you are sort of stuck in that limbo. So you could see the trap is that if you buy under your personal name, if you do that, you pretty much capped out around 3 or 4 properties in that instance. Now, the secret is, how do you avoid this issue? How do you avoid this trap in terms of being capped out around 3 to 4 properties? Well, the way you can do it is you can buy under trust or company structure. And the reason why is that if the trust or company is self-sufficient, some banks, not all the banks, some banks will exclude these loans from your borrowing capacity. So let me explain how it works in the real world. So let's say you buy your first property, you got your first one, right? And then you go buy your second one. And as long as the first property is self-sufficient, what will happen is the banks will exclude this loan, right? So they exclude this loan. And when you buy your second one, it's as if your borrowing capacity remain the same, as if you're buying from day one. Now, the key component is that it has to be self-sufficient, right? But it's as if you're buying endless amount of properties. You can do this, repeat this over, easily 10 to 20 times. You can repeat this process where, let's say you buy another one, the banks will exclude this one, and then they only have one debt per property. So I'm going to explain what self-sufficiency means. So what does it mean? Well, it's where the rental incomes covers the expenses, right? And here's an example. Let's say you got a rental income of 40,000 a year. Your expenses are 39,000. So that includes mortgage repayments, rates, maintenance costs, agent fees. And as long as that equation is done, this property is self-sufficient. And the way the banks verify, some banks, they just based on your word, you tell them, yep, it's self-sufficient. Other banks will just require an account letter to confirm it's self-sufficient. So the same example, a couple earning 200 grand, buying 750,000 with 650 property. As you can see in the example before I showed you, your borrowing capacity remains the same. So it's always going to be the same regardless of how many properties. Now, there is one drawdown is if you do buy under trust or company, not all banks, right? A lot of the banks won't factor in the negative gearing, which means that your borrowing capacity is reduced by 10 to 20%, but there are some banks that will factor in negative gearing when you're buying the trust. So how you can implement this strategy to yourself. So what you can do is either choose option one is to buy all the investment properties under trust, right? So this allows you to maximize your borrowing capacity. Or the second option is you have the primary residence under your own name and the rest of the properties under trust. And the reason you do that is because if you have your primary residence under your own name and you sell the property, you can have a CGT discount. So you don't pay any capital gains tax. If you had the primary residence under trust and you sell it, you have to pay CGT, right? So you have to pay capital gains tax on that. Now, key rule is try to have only one property per one trust. And a key note is not all banks do trust lending. There's just a few that do trust lending, and there are fewer that do implement this loophole that you can do. You can always contact a mortgage broker to find out. Someone like myself, I can tell you which banks do, which banks don't. The reason why I can't tell you this bank does it or the other banks don't do it is because banks' policies change all the time. So one bank says yes today, could be tomorrow they say no. So best to contact a mortgage broker or someone like myself, the way I can sort of give you up-to-date information about how it works. So here's an example of where people buy 10 to 20 properties. So this person's earning 120 grand a year. So, and they're able to own 12 properties and still able to buy more. The reason is each property is 480 and it's rented out for 400, and each one is self-sufficient in their own trust. And because of that, they're able to rinse and repeat, take the equity out, buy the next one, buy, rinse and repeat, buy it, until they have around 12. Now, another common question is what happens if you're already capped out? Well, if you're already capped out, you can either sell an investment property, do debt recycling to help you increase your buying power, or move a property into a trust, which I don't recommend because you have to pay CGT and you have to pay stamp duty, or over time when the properties change from, over time, as the rents increase, the mortgage goes down, over time your buying capacity goes up. Now, a common question is, how do you make your property trading profitably, i.e. self-sufficient? So the couple strategies that you can implement, one is have the loan as interest only rather than P&I. And the reason why is because the repayments on interest only is a lot less than P&I. For example, if there's a loan $600,000 at a 6% interest rate, the repayments is around $3,000 interest only, while in comparison, if it's principal and interest, it's $3,600 per month. So that's about a $600 difference, right? So that's $600 per month difference in cash flow. The second one is have a larger deposit, right? So obviously the bigger deposit you have, the less of a repayment. So also the bigger deposit you have, if you've got a 20%, you don't pay any LMI. You also get a better rate. So these are things that you can do to help you, get a better deal and also improve the repayments. The third one is find properties with high yields. So about 4.5 to 7%, usually around the 500, 700,000. These decent yields can allow you to make it very easy to cover the holding costs, especially with an interest only loan. And especially if the market dips or there's cash flow issue of having some cash flow issues, if you have good yields, it can make it easier for you to hold the property. Now, high yields are often found in regional areas, interstate, where you can find a property between 500 to 700,000 with really decent yields. The fourth strategy is if you buy an investment property, over time, it's most likely that it will start as negative geared, and over time, as the rental income increases, the loan decreases, it will become from negative geared to neutral to positive geared. Now, like I said before, borrowing capacity under trust is usually lower. And the reason is because negative gearing isn't applied to your personal income. So that means that it's often reduced by 20 to 30%. In saying that, there are certain lenders that do exempt that allow negative gearing to be applied under trust. So just keep that in mind that that's not a hard and fast rule. Now, I'm pretty sure you are asking, what is a trust? So a trust is a legal entity where a trustee manages all the assets on behalf of a beneficiary. So this is a structure. You got a trust, you got a trustee, you got beneficiaries, and you have the property in the trust. Now, this is the structure. You got a trustee. So this is the person managing the property. They hold the actual legal ownership. So for example, you can have this as an individual, right? So John Smith, or you can have this as a corporation. So ABC Pty Limited. Normally, it's best to have it as a corporation for asset protection and better lending policies. So if someone sues you and the property is under trust and it's under a trustee, then it's very difficult for them to get access to that property if they sue you. Now, the beneficiaries are the people that benefit from the trust. So they're the ones who receive the income, either rental income or the profits when the property is sold. So this could be yourself, your partner, or your kids. Now, there are two common types of trusts. For property investing, there's a discretionary trust, which is a family trust, where that means that you can have flexibility in terms of the income distribution. And the other one is a unit trust, which means that in terms of the distribution, it's fixed, right? So if you and your wife own the property 50-50, now there are two types of trusts that are common in property investing. There's the discretionary trust, which is a family trust, which means that you can have flexible distributions. And there's a unit trust where the fixed ownership in terms of the distribution. So what that means is, let's say it's you
and your wife. In a discretionary trust, you can choose to have, let's say, 1 year it made 100 grand. You can have 70 grand go to you, 30 grand goes to your wife, and you can change it up year to year for tax purposes. With a unit trust, it's fixed. So if it's 50-50 ownership, the distribution is always going to be 50-50. Now, for what type of trust you should have for property investings, generally you should have a discretionary or unit trust. You can have the trustee as an individual or corporate trustee. You recommend better for corporate trustee for asset protection. For corporate trustees, the individuals have to be the guarantor, which means that you as a borrower have to be the guarantor. For individual trustees, the individuals have to be the borrowers in their own capacity and act as a trustee for the trust. A key factor is the trust should be a non-trading entity, which means that it's not designed for business or anything else. It's designed for the sole purpose of just investing. Another thing is that for the trust, it must own less than 5 properties in the trust and only have natural people. So only have people as the beneficiaries, right? So my preferred setup is either a discretionary trust or a unit trust, a corporate trustee, individuals to be guarantor, and just have the trust setups exclusively for property investing. And here's an example of a setup. So you got Bob and Jane. They want to set up a business, a trust together. So they have Banana Pty Limited, right? And they've got the Banana Trust set up, and they've got the people set up. So they've got Bob, Jane as the beneficiaries. They've got the kids potentially as the third beneficiaries, and they have the appointments set up. And it's a really easy structure to follow, right? And people who set up are usually the accountant. The accountants usually set this up for you. And when you buy a property, it'll be the trust, Banana Pty, acting as the trust for this. Now, what are the pros and cons of buying properties in the trust? Well, the pros are it can be really good to help you build a property portfolio and have more than 3 or 4 properties, right? If done correctly. It's also good in terms of tax efficiency. So if you have a discretionary trust and you can distribute the profits between yourself and your partner and your kid, that can be really good in terms of reducing the tax. There's also another benefit is that there's lower tax on a larger portfolio. So if you have more than 1 or 2 properties, you can set up multiple trusts and have you all be under the threshold. And that can be a really good way to avoid paying huge amount of land tax. The other benefits are asset protection. So if someone sues you and you have the property on the trust, then it means that you are protected. You can sort of shield yourself against being sued. And overall, it's pretty good, especially the tax benefits is when you have a large portfolio, it can really outweigh the costs and the capital growth that you experience by having multiple properties in the trust. Now, those are all the pros. Here are all the cons, right? So the cons are usually it's like a setup cost, right? So each trust can cost between $2,000 to $3,000 to set up. And there's usually like a ongoing fee of between $1,000 to $2,000 a year, right? It's also much more complicated. So instead of you buying you and your wife, you got to have to set up a trust, you got to have to set up a trustee, you have to set up all these other parties involved with it. It's also con is that there's higher land tax for, if you're only having 1 or 2 properties in the trust, you're paying land tax, which is higher in most states because now you don't have that tax-free threshold that you'll get if you were to buy it under your personal name. The last negative, and the big one is the negative gearing, is trapped in the trust, right? So what that means is, let's say you made a loss of $10,000 on the property. Normally, if you're making 100 grand, you can to take that money off your income, so you're only paying tax on 90 grand. But if it's under the trust, you can't do that. You have to wait until the trust makes a profit, and then you can offset that loss against that trust itself. You can't offset the losses against your personal income. So overall, these are the biggest benefits. These are the biggest cons. Now, I just want to cover through some risks. If you buy a trust, there's no different risk to buying it under your personal name. But the biggest one is if the trust becomes unprofitable, it means that you can't exclude the loan from loan applications, making it very difficult to refinance. If one trust is also unprofitable, it can create a domino effect. This trust is not profitable, then it can create domino effects with other properties in the trust having the same effect. And it's like a house of cards. You've got so many properties on the trust, you bought too many, and now it's collapsing on you. This is really important, especially since this last few years, there's been about 13, 14 rate increases. So if you had multiple properties on the trust, it could cause this domino effect where now all these properties are not profitable. you're losing money, and then you have to sell a few properties to sort of keep afloat. So how to avoid this risk: make sure there's enough equity, always make sure there's enough cash flow, and make sure you calculate the figures and make sure there's enough cash flow coming in to make sure that even if it went to P&R or the rates went up, you still be able to cover those repayments. Now, key thing is regarding land tax and how it works for individuals and trusts. And I want to really spend some time going to this point just so you can really understand it. So land tax is calculated per person per state, and it's pretty much a tax you pay for owning property. And with each state, there's each tax-free thresholds that apply for if you buy on the individual or buy on the trust. So each time you have a trust set up, right, it's a separate entity. So it means that each trust has a separate land tax threshold in some states. However, in New South Wales, Victoria, and Queensland, trusts usually don't get a tax-free threshold. So this is their ramification. So here's the guide. So if you have a land tax when buying on the trust, so in New South Wales, if you buy as a personal name, up to $1.075 million worth of the value of the home, you don't pay any land tax. But if you buy on the trust, you pay land tax from day one. The only exception is if you buy under unit trust, you might be exempted from the threshold. So if you buy under unit trust, you might be able to have the individual threshold of $1,075,000 when buying under trust. Now in Victoria, it's $300,000 for individuals and $25,000 for trusts. In Queensland, it's $600,000 for individuals, $350,000 for trusts. In WA, so you can see that most of the times, if you buy in the trust, you don't get the threshold as great as a threshold. Except for the Northern Territory when there's no land tax. So what that means, so you're probably thinking, what does this mean? So here's what a real life example. Let's say you bought property, the land's worth $500K as an investment property. In New South Wales, if you bought under your personal name, you pay $0 land tax. But if you bought on the trust, you pay $8,100 a year. In Victoria, you pay $1,545 a year in land tax. If you bought on the trust, you pay $5,000. If you bought in Queensland, it's the same, $0. If you bought on the trust, you pay $1,500. WA, etc., to South Australia and Northern Territory. Now, that's the thing you got to keep in mind, the cost, right? So for you to make this viable, the best way I make sense of it is if this property goes up by 10%, so let's say it goes up by 10%, you made 50 grand, but the cost was only 5 grand, then in principle, you made 45 grand. And that's how you justify that in making the investment decision is what do you think the property growth will be for the next 5-6 years? And that makes sense in terms of I rather get the bigger picture, I rather make the overall capital growth, even though I lose 5 grand, but I made 45 grand in the transaction. Now, in some instances, if you have multiple properties, a trust is better because if you own multiple properties, and you have each one under an individual trust, right? It's viewed under separate threshold. So for example, right, let's say under a personal name, you got 3 properties worth $500,000. Now your land tax is on 1.5, right? But if you have them under thresholds of a separate trust, each one, let's say each trust has $500K, then you only assessed at paying land tax at $500K rather than 1.5 million. And in some states, you don't pay any land tax depending on where you go, right? If you want to get started, if you do want to buy under trust, the main thing is first, you need to talk to a broker like myself. The second thing is after you talk to a broker, you need to talk to an accountant. He set up the trust, then you get pre-approval, then you proceed as normal. The only thing is trust is a little bit more paperwork. It might take a week or 2 longer to set up, but overall, it's just the normal as if you're buying a normal property. And if you're interested to get started, please go to my website, www.heroeshomeloans.com.au, and feel free to book in a free 30-minute consultation call where I can go into much deeper for you and see if this is viable.